Hi everybody, welcome to today's video. We're going to be talking about how to protect your investment gains. This is particularly important for those of you who are trying to conserve your estate value. I know it's also on your mind. For those of you who are not thinking about your estate value, you're still a little bit younger, you're trying to figure out how do I protect my gains going forward. So this video is for both of those groups of people. You're going to enjoy it. If you're new to my channel, hi everybody, my name is David. I'm an active advisor working with families, business owners, and individuals right across Canada. I make YouTube videos on financial planning, retirement planning, estate planning, life insurance. Basically, if you're trying to protect your money, grow your money, and understand how to actually do some retirement planning or financial planning, you've come to the right channel. I speak to you on these videos as though you and I are having a conversation across the table. Nothing should fly over your head. I try to always deliver the material in such a way as you should be able to understand exactly what's going on inside of a couple minutes, okay? So if you like this content, subscribe to the channel and share it with everybody you know. Okay, let's get into the video and why you're here in the first place. What you're looking at right now is the Toronto stock market from 2008 to 2022. That's the 15-year period. And this is actually going to be the chart that I use throughout the entire presentation, so it's consistent and we can see exactly sort of like apples to apples, right? So what I want to share with you is if you're invested in a stock portfolio, a bond portfolio, ETFs, or mutual funds, this is what's going to, I think you're going to agree with me here, but this is what happens. Let's say you deposit $100,000 into the market, and that dotted line represents your cost, how much money you actually deposited. That's your cash going into the market. And can we all agree that if you passed away at this particular time, that your beneficiaries are going to receive more than what you deposited? Pretty simple, right? And I know if you're in the advanced area of financial planning and investing, stick with me for a minute. It's going to get better, okay? But I need to make sure you're all aware of what we're looking at. Now, can we also agree that if you had passed away at this time, that your beneficiaries will have received substantially less than what you deposited into your portfolio? Does that make sense? Okay, so that's important. So anything above that dotted line is you're making money. Anything below the dotted line is you've been losing money. Okay, let's go into the next thing. Let's say you used segregated funds and deposit $100,000 into a segregated fund portfolio. You can only get it in an insurance company. You cannot get it at a bank. And there's your cost going in, same thing, we're not changing anything, but that line actually represents to an insurance company the death benefit guarantee of 100%, which means if someone had passed away at any time along that period and their money was less than $100,000, the insurance company had to top it up back to $100,000 and their beneficiaries received nothing less than $100,000. Okay, that's what a death benefit guarantee means, is that they have to protect your principal at your passing. Okay, so this is important. So let's dig into this. You're going to love it. Okay, let's presume now you're still in a segregated fund. You've deposited $100,000, and these are the losses that occurred in the Toronto stock market over the 15-year period. Now, when I say losses, I'm meaning below that $100,000 deposit. I'm not talking about when it goes up and it comes down a little bit. We're talking about actually below $100,000. That is what the death benefit is ensuring, basically. It is making sure that if any time that your portfolio is below what you deposited, and you pass away, they have to top your portfolio back up to the $100,000 mark. You're not suffering any losses, okay? That is particularly important. Okay, but what if you wanted to actually lock in market gains? Look at it from a different angle. Instead of just thinking about, okay, what about protecting my principal? I want to make money over these years. Let's look at how that works. In a segregated fund, you deposit $100,000. There is your death benefit guarantee. And let's say the market goes up. Here are all the times where your portfolio hit all-time highs in your portfolio over 15 years. So yes, your portfolio went down and you had 35% losses in 2008, but those red circles represent new highs of market balances in your portfolio. And you watch the portfolio go down, come back up, go down and sweat it out and go up again. This is what we're going to talk about. How do we protect Not so much that the market is going to go down, but how do we protect the values going forward so we never have less than our highest value going forward? This is, I think, important for you to see how this works, okay? So let's start. $100,000, there's your death benefit guarantee. The market goes up to $150,000. So we're going to use what's called annual resets. Now, not every company has annual. Sometimes they'll have every 3 years, and most companies have just every 15 years it resets. But you can also get companies that will provide annual resets, meaning the market goes up, and instead of guaranteeing $100,000, you elect to choose an annual reset, and now we're going to move that reset up to that $150,000 mark. So now we're protecting the gain. Now, if you passed away during a market correction in 2008 like this means that your $150,000 is now guaranteed. It's no longer the $100,000, it's the $150,000. So you've managed to lock in your gains at the highest point and protect that $50,000 going forward. So now you're actually conserving your estate going forward as you invest. Okay, let's look at it going forward to the next period. Remember, just to back up, that dotted line that I just put back on the screen, that was your original guarantee point. So you can see here, we've now elevated the amount of money that the insurance company has to be paying you if you pass away. They have to pay you at least $150,000 or pay your beneficiaries, okay? This yellow line represents 5 years of negative returns. Not just negative, but losses. In 2008, it took about 5 years for most of people to get back to what they had originally deposited. So you can think about the value of having a death benefit guarantee, especially at 100,000 or 100%. We're not talking like in 2020 where the market dropped and came back up pretty quickly. That was a long time for people to be sweating out. And think about, instead of 100,000, think of $1 million, $2 million, $5 million. It's a lot of money that would have been below if you were just invested in the index. But it's a lot of money for you to be thinking about how do you protect going forward, how do you protect your estate value. 5 years is a long time for you to be thinking about that. So if you had been in a position where you were in a segregated fund and you knew that you were not protecting the 100,000, that you were protecting the 150, the gain that you made, you're not really that worried. You want the market to come up. You know that it's going to come up because you can see that in this chart. It always comes up. But you're protecting the top mark of your portfolio, okay? All right, let's look at what happens when we go along this timeline. The market comes back up, recovers. It's now 170,000. So now we're going to move that guarantee. You see that dotted line is now moved a little bit higher. And we're now protecting 100% of that $170,000. Let's move forward. The market's now gone up to $200,000, and that dotted line, that's your death benefit guarantee. It's also now protecting $200,000. So no longer are you protecting $100,000. You now have $200,000 guaranteed that if you pass away, the insurance company is not going to give anything less than the $200,000. And then we move up to the top. The market was at the all-time high, and it's now $400,000, your portfolio. And now your portfolio is guaranteed that if you pass away, no less than $400,000 is going to your beneficiaries. So from $100,000, even though the markets went up and down, you were able to lock in your gains going forward and ensuring that your estate value was being preserved the whole way through. This is extremely important for those of you who have partitioned off a certain amount of money that you intend that you'll never spend in your lifetime. This is going to be dedicated to your estate. This is particularly important for you to use this kind of setup for your segregated funds so that you can make sure that you're protecting the estate value as you go forward, and you don't have to be concerned about these times when the market is going to crash, as we've seen. And in the 15-year period, we've seen a number of these, right? That's not going to go away. Those things are going to continue. So I hope this information was very useful. And if you have any questions around how this might work for you, please get in contact with me. I'm happy to walk through exactly how that would work for you. I always end my videos when we say we take care of your wealth management so you can take care of what's most important to you. There's my contact information. There's 5 million ways to get in contact with me. I look forward to hearing from you, and I look forward to seeing you in the next video. Thanks for tuning in. Take care.